One of the most important drivers of decentralized financial growth has been yield farming, as it provides investors with an equal opportunity to increase their profits. But what is yield farming? Stay tuned to find out. Yield farming is the practice of maximizing returns using decentralized finance, DeFi, by lending or staking crypto assets on a DeFi platform in exchange for cryptocurrency. Yield farming systems encourage liquidity providers, LP, to stake or lock their cryptocurrencies in a smart contract-based liquidity pool. In general, yield farming benefits are offered to users that perform protocol-friendly tasks, among which are: liquidity is pooled into a contract to supply markets, increasing liquidity to become a more significant major market maker or to receive a discount, vote pooling, locking some cryptocurrency assets, a percentage of the transaction fees collected by the underlying DeFi platforms, interest from lenders, or governance tokens can be used to provide the yield. The first step is that you must first deposit your crypto assets into liquidity pools as a liquidity provider. But wait, what are liquidity pools? Liquidity pools are a type of smart contract that allows investors to receive a return on their tokens while facilitating asset trade. Traders can use these tools to conduct trades on automated market maker (AMM) systems without needing authorization. Traders must pay trading fees in order to use the liquidity pool. The costs are then split among all liquidity providers based on the quantity of liquidity in the pool. In certain pools, participants may additionally earn the platform's governance token as an added incentive. You will experience impermanent loss if the token amount in a liquidity pool varies often. If the price of token X declines, the scenario might be reversed, with more token X being sold back to the pool in exchange for token Y. Calculating impermanent loss, especially for dual asset and multi-asset pools, can be difficult. You may use CoinGecko's impermanent loss calculator, linked in the description box below, to simulate impermanent loss on dual asset pools. Liquidity provider. To offer trading liquidity, users deposit two currencies to a DEX. To switch the two tokens, exchanges charge a modest fee, which is paid to liquidity providers. This charge might be paid in fresh liquidity pool tokens on occasion. Lending. Token holders can earn interest on the loan by lending their crypto assets to borrowers via a smart contract. Borrowing. Farmers can use one token as security for another token loan, where the borrowed funds can then be used to farm even more. This allows the farmer to maintain their initial investment, which may appreciate in value over time, while also receiving interest on the borrowed coins. Especially so when borrowing is incentivized by certain new projects eager to attract users and liquidity. Staking is a way of earning rewards for holding certain cryptocurrencies. It is a way of letting crypto do its work for you. These are a couple of staking examples. On proof-of-stake blockchains, a user gets paid interest in exchange for pledging their tokens to the network as security. The second option is to stake liquidity pool tokens obtained by providing liquidity to a DEX. Users may earn yield twice, since they are compensated in liquidity pool tokens for delivering liquidity, which they can then invest to gain more interest. Uniswap is a decentralized exchange system based on the Ethereum blockchain that allows for peer-to-peer, P2P cryptocurrency trading. The Uniswap DEX uses a liquidity pool approach with automated smart contracts. To get the major source of market liquidity, potential traders might access various token reserves financed by users. The liquidity suppliers establish so-called liquidity pools. In a liquidity pool, two separate crypto coins are deposited. If the system does not yet have a liquidity pool for a trading pair, it will be implemented as a new smart contract on the Ethereum blockchain. Anyone who wishes to convert the two crypto coins may now do so using this liquidity pool. If a trading partner wishes to withdraw tokens from the pool, he must do so in the currency of the pool. Other examples of DEXs include SushiSwap, PancakeSwap on Binance Smart Chain, Trader Joe on Avalanche, Astroport on Terra, Trisolaris on Aurora, and more. Aave is a non-custodial, open-source, decentralized lending and borrowing protocol that allows users to borrow assets and receive compound interest for lending in the form of the Aave token. With over $13 billion in value locked up and a market cap of over $2.2 billion, Aave is one of the most extensively utilized stablecoin yield farming platforms. The Aave token encourages users to use the network by offering incentives such as fee reductions and voting power in governance. Other money market protocols also include Compound, Benki on Avalanche, Solend on Solana, Mars Protocol on Terra, and more. Curve is a decentralized exchange that specializes in pegged asset swaps, such as fiat-pegged stablecoins and assets that trade at a 1-to-1 ratio. 3Pool is Curve's largest pool, which includes DAI, USDC, and USDT. And because Curve utilizes its native currency to reward liquidity providers instead of increasing exchange costs, stablecoin pools have gained popularity by delivering high liquidity and cheap fees. The base APY can be as high as 10%, while the incentives APY can be as high as 40%. Stablecoin pools are typically safer since their peg value does not depreciate. Yearn is a liquidity aggregator that offers automated yield farming strategies across many loan pools. Yearn Finance, the protocol's most well-known pool, moves cash across leading DeFi lending protocols with the goal of giving lenders the highest return on liquidity. YFI is the Ethereum token that governs the platform, and users can earn these tokens by locking their crypto assets operating on the balancer and Curve DeFi trading platforms. YFI's recently introduced liquidity mining strategy has been one of the highly discussed yield farming tactics. Users stake their proof of liquidity in any of the supported ygov.finance pools in return for YFI rewards. Other yield aggregators include Beefy Finance, AutoFarm, and BarnBridge. Anchor is a decentralized money market created on the Terra blockchain that pays depositors a 20% annual percentage yield in UST, Terra's dollar-pegged stablecoin, although that has been readjusted downwards slightly recently. Anchor's inflationary protocol token, ANC, provides holders with governance rights as well as a share of the protocol's revenues. The Anchor rate is supported by a diverse supply of staking rewards for major proof-of-stake blockchains, making it far more stable than money market interest rates. Users may deposit staked collateral here, with the protocol earning staking incentives, and users who borrow get reimbursed in ANC tokens, but pay interest in UST. You are advised to do your research before participating in yield farming. Here is a list of questions that you may ask yourself before participating in any liquidity pools. Is there a better place for your asset? How established is the protocol? Is there a single admin key? How is the yield generated? Is the protocol audited? Is there a lot of liquidity? Can you sell your yield at a specific price into another asset without slippage? Will the yield farming activity result in a high and permanent loss? How trustable is the blockchain on which this is running? What do you think? Comment below and let us know what you like or don't like about yield farming and what other protocols that are worth noting. If you like to stay updated on all things crypto and learn new things about the cryptoverse just like this video, make sure you click on that subscribe button and turn on the notification. See ya!